Based upon our discussion last week related to audit quality, I wanted to provide some additional guidance related to this very specific and actually important conversation that has a direct impact on the actual audit. When we talk about audit quality, the first thing that we want to do is want to define what audit quality is. Well, based upon a definition that was put together in 1981, what it's describing is the definition of audit quality is the market assessment joint probability that a given auditor will both discover a breach in the client's accounting system and B, report the breach. So what we're focusing on, again, is what is the role of the auditor? The auditor is to provide an opinion of the fair presentation of the financial statement. So he or she is looking for material misstatements within the financial statement. So an audit quality is one that's given or performed by an auditor who has the ability, has the skill set to actually identify these things, and then has the ability to present this in his or her report related to the audit opinion, as well as communications to the board of directors. The Government Accountability Office also has a definition. This is somewhat expanded. Keep in mind that what we're talking about is a quality audit. Quality audit is conducted in accordance with generally accepted auditing standards, or GAAP, to provide reasonable assurance that the audited financial statements and related disclosures are presented in conformity with generally accepted accounting principles in the United States, and that they are not materially misstated, whether due to error or fraud. So we know that this is the output that we expect to get from the audit, assuming there are no material weaknesses within the financial statement. Now, this GAO definition goes further. The auditor appropriately detects and then deals with known misstatements by, number one, ensuring that appropriate adjustments, related disclosures, and other changes are made to the financial statements to prevent them from being materially misstated. So the idea is that as we identify these material misstatements, we are going to be working with management to make the appropriate adjustments so that we can then express an opinion that the presentation of the financial statements are presented fairly. Number two, modifying the auditor's opinion on the financial statements if appropriate adjustments and other changes are not made. So if we identify material misstatements and if management is not willing to make the changes that we are requesting, we need to be able to make adjustments to our opinion letter, where we're going to report that there is a material change related to the financial statements and there's a qualified opinion, or perhaps even an adverse opinion. And then you notice here that a quality audit is done in such a way that, if warranted, that we are able to or willing to resign as the public company accounting auditor of record and report the reasons for this resignation to the SEC. So the SEC, through the Sarbanes-Oxley Act, places a very strong burden on the auditor. So the auditor is ultimately expected to express a fair presentation opinion unless there are material misstatements. So if there are material misstatements, the first thing that he or she wants to do is to work with management to make the corrections. If management is not willing to make the corrections, the auditor needs to be able to make the adjustments in his or her opinion letter to state that the financial statements are not presented fairly, or identify the qualification to the audit opinion. And then finally, if all of this fails and we come to a conclusion with the audit or the client that they're not willing to work with us, we need to be able to resign, as the auditor of public record and to report to the SEC based upon the reasons for this resignation. The Public Company Accounting Oversight Board is issuing this concept release to seek public comments on the contents and possible use of a group of potential audit quality indicators. So what we've talked about before is the fact that the concept of quality is somewhat nebulous, meaning it's very hard to specifically identify what these quality indicators are. And frankly, as I'm reading through this PCAOB report, I actually kind of like some of the ideas that they're coming up with. There are three groups of quality indicators. The first relates to audit professionalism. Now kind of think about some of these things and think about how these will in fact impact quality. Availability. So we're looking at the staffing leverage, partner workload, manager and staff workload, technical accounting, and audit resources. Basically what we're saying is the audit firm providing sufficient resources to the audit so that the audit can be performed. And then the final point in terms of availability, persons with specialized skills and knowledge. So is the audit firm actually providing the right people to the organization to complete the audit? Competency, the experience of the audit personnel, the industry expertise, turnover, the amount of audit work centralized at service centers, and then finally, looking at this last item under competency, training hours per audit professional. We had talked about last week how that training within the audit firm becomes a part of the culture. A culture of an audit firm with a high quality culture is going to invest the resources in identifying professional people and spending the time and the resources to continue to train these people. Ultimately, what we're looking at here in terms of professionalism in focus is the audit hours to risk areas and the allocation of audit hours to phases of the audit. So ultimately, the amount of time that the auditor spends on the audit truly does impact the quality of the audit. Look at the audit process, and you notice how the audit process, in fact, may drive many of the things that relates to the interaction of the audit firm and the client. The tone at the top and leadership, the results of independent surveys of firm personnel. So we certainly want to make sure that we are working with a firm that has a strong professionalism, a strong quality culture. Incentives, quality ratings and compensation, audit fees, effort, client risk, independence, compliance with independent requirements, infrastructure, the investment in infrastructure supporting quality auditing, and then finally monitoring and remediation, the audit firm's internal quality reviews results, the PCAOB inspection results, technical competency testing. So what we're looking at here is we're looking at a firm that places a high degree of energy and resources in terms of the process and making sure that the firm in and of itself is a quality firm. The last piece relates to the results, the audit results. So again, we're focusing on audit quality indicators. Financial statement, the frequency and impact of financial statement, restatement for errors, fraud and other financial reporting misconduct, inferring audit quality from measures of financial reporting quality, internal controls, timely reporting of control weaknesses, timely reporting of going concern issues, result of independent surveys of audit committee members. So what we're looking at here is we're looking at how the audit firm is actually communicating with those in charge of governance. Those in charge of governance, generally speaking, we're talking about the audit committee. When we're looking at enforcement and litigation, we're looking at trends in the PCAOB and SEC enforcement proceedings, as well as trends in private litigation. So in this very brief video, what I wanted to focus on is audit quality audit quality indicators and give you an indication of how the industry, primarily driven by the PCAOB, truly believes that audit quality is important. And what we're trying to do at this point is attempt to measure this quality so that the quality of the audit reports that are coming out and being reported as part of the financial statements are of a specific quality. Thank you for your time.